Hello, I'm Jeffrey Ham, equity analyst for Briefing.com. Today is Wednesday, July 23rd. Drug maker Pfizer announced earlier this morning 9% revenue growth and 31% earnings per share growth year over year. Specifically, revenue totaled $12.1 billion and earnings of 55 cents per share. The results were better than expected. Analysts were looking for sales of $11.5 billion and earnings of 54 cents per share. Pfizer also guided its full-year outlook in line with the consensus forecast. The company sees sales ranging from $47 billion to $49 billion and earnings that range from $2.35 to $2.45 per share. Meanwhile, the average estimate calls for sales of $48 billion and earnings of $2.35 per share. Though the latest performance may offer investors some encouragement, shares of Pfizer have done little to reward long-term shareholders during the last several years. Notably, the stock has fallen more than 60% from its high in 1999. Given the challenges facing the company, like expiring patents, narrowing drug pipelines, and rising healthcare costs, analysts are predicting little growth for the stock. In fact, at its current price, the stock trades with a price-to-earnings relative to growth ratio of 12.8. Perhaps the most compelling fundamental reason to take an interest in the shares is their 7% dividend yield, which is really a result of the stock's depressed price. Generally, the steady and stiff headwinds challenging the highly competitive pharmaceutical industry outweigh the reasons to take an interest in Pfizer at this time. That being said, speculative investors may argue that the company could be looking to merge or acquire additional assets to help it better compete, much like many biotech firms of late. I'm Jeffrey Ham for Briefing.com, and thanks for listening.